Hello, everyone. Welcome back to Reimagine 2021 version 10. So this is actually our 10th anniversary edition of our event. We've been doing it for a whole year now, bringing you the latest founders, innovators, and the latest news in the space. I'm Roshan Mirajkar, one of your hosts for this event, and I'm very excited to be here with a returning Reimagine guest. So with me here today, I have Scott Melker, who's the host of the Wolf of Wall Street's podcast. Scott, welcome back to the show. And it's been a crazy time in the crypto market, like in the past couple of months. So, what are some of the most important factors you see like affecting the market right now? Let's just start with that, maybe.
Well, I think number one is probably leverage. And it's the one that's least talked about because obviously there's all kinds of mainstream narratives from people that don't understand the market. But if you really look at the price action, when you talk about the roller coaster of the past few months, I assume you mean the very parabolic rise and more importantly, the equally parabolic dip to the downside of around 55% drop for Bitcoin. And primarily that's a function of the system having too much leverage, right? We have exchanges that historically have been able to offer traders up to 100, 125x leverage, meaning that if Bitcoin, which has implied volatility of 5 or 6% a day, moves 1%, you get liquidated, right? And each of those liquidation orders on the way down becomes a sell order, causing more sell orders on the way down. And we saw about $10 billion liquidated from 60,000 down to 50,000 in almost 1 million individual traders' accounts. So there's your story, which is how a small problem becomes a very large problem. And that was the same story basically from $40,000 down to 30,000. So if you're wondering how the crypto market moves so fast and so violently, primarily it's because of cascading liquidations on leverage exchanges. So you have all the mainstream narratives, all the news medias, ransomware, electricity, you name it, the same ones that are recycled every time Bitcoin drops, but those are just very small catalysts or stories that are used to pile on when kicking a man when he's down, so to speak. So I would say that if you zoom out and you look at the market with some perspective, Bitcoin was trading under $4,000 in March of 2020, and it's trading almost at 40,000 as we're speaking today. That's approximately a 10x gain. So remove the crazy price action up to 65 and back down to 29, and you'd be very, very happy if you entered almost at any point over the last year. You could potentially be up 10x. So I think it's all very natural market movement in a nascent market. It's a free market. And so there's no centralized authority that's going to step in and help if price drops. But more importantly, it doesn't require centralized authority to step in and help. If the stock market dropped 55%, and we've seen what happens when it drops 35%, we would have the Fed stepping in, printing money endlessly, quantitative easing, buying bonds, buying stocks, buying everything to make sure the market goes down. In the Bitcoin market, it drops 55% and everything continues to work as normal, right? So, and to me, that's a huge indictment of the other system and a huge plus and positive for Bitcoin and this market. So the reality is, yes, it's been a major roller coaster, but we're seeing a nice bounce now. And I think we'll probably talk about all the different narratives, institutional adoption, the things I mentioned, ransomware and energy, if those are interesting or not, and probably more importantly, impending regulation. All the things that potentially are weighing it down for the moment, but I believe once we have clarity, will allow it to spread its wings and fly once again.
Yeah, definitely. And in our market, there's no like bailouts, no one to really come in and save the day when we have all these liquidations and different things like that. In the traditional market, you sort of have these circuit breakers, and I think I don't know if that's always a positive thing because it's like a net for these companies, even when they do nefarious things. These institutions they sort of don't really get in lots of trouble, but
nobody gets in trouble.
Yeah. So even like I know you're a big fan of like some of your trading strategies. You're a big fan of dollar cost averaging and buying daily. And I know you spend a lot of time with just educating like retail users through your newsletter and different forms. So what are some general tips that you give to your community and how to like safeguard your assets and not necessarily make a lot of money, but yeah, what do you tell them in these times where everything is so volatile?
Buy. right? You buy the dip. That's what you do. And you continue buying the dip because you believe that over time an asset will trend. But the caveat of buying the dip is you have to have a multi-decade timeline. You don't buy the dip and expect not to lose money in the next 5 days or 5 months. You buy because you're investing and anticipate that you'll be holding these assets in your retirement, the same way that you would approach the stock market. If you look at a chart of the Dow Jones and its history, there's never been greater opportunity than the Great Depression, the Great Recession, the dot-com boom. Every time that the market had a tremendous drop, it was temporary and the market continued up. And so anyone who was cash flush and willing to buy when there was fear was rewarded handsomely, right? And so I stress very heavily to people, and I'm not a financial advisor, I just tell them what I'm doing. But I stress very heavily that you should be an investor first. If you're going to trade, you're probably going to lose. So do it with a very small percentage of your capital, and probably you will lose that money. But as an investor, if you want to take all of the emotion and stress out of it, you just dollar cost average, right? Buy every Monday at 9 a.m., regardless of the price, a fixed amount, and don't look at it and don't touch it. And it has to be money that you're willing to put away and not touch for years and years, if not decades and decades. But it's funny, there's a famous quote, and I'm trying to remember who said it, but it was effectively that, human beings will buy anything when it's on sale except for stocks, right? And so for some reason, when you see a financial instrument drop 50%, that gives you panic and fear. But if it was anything else in the world, you would buy it without even a hesitation, looking at it as a 50% discount. That's how I view Bitcoin right now. Even if it goes to a 60% discount, I don't care, because I believe that one day it'll trade 6 figures, potentially even 7 figures, much, much higher. So, the reality is I just tell people to zoom out, not get fixated on price action at all. Remind them that most people who have accumulated wealth over time have never looked at a chart or worried about a trade. They've just bought things and closed their portfolio and checked it quarterly and readjusted and waited years to see if there was a benefit.
Yeah, I mean, the best feelings are those people that locked away their Bitcoin, or they forgot they even mined it, and they check it years later, redeeming it now. And some people have lost keys and different things like that. So definitely longevity is the name of the game in our industry, whether that is holding your position or remembering your keys.
In every industry. Right. In every industry. Mark Yusko, the principal at Morgan Creek, shared a great story with me recently. And he told me that, he said, Scott, do you know what the best performing assets and portfolios are at Fidelity? And I said, no, I have no idea. He said, deceased. He said, the people who died and nobody claimed them, those have performed the best. The disabled, inactive, and deceased. The ones who have never touched it are the accounts by far that have performed the best. People are their own worst enemies. They get in their way because they're impatient or fearful. The reality is, if you just buy and wait a very long time, you will most likely do exceptionally well.
Yeah, and a lot of these assets are still maturing. So like no one's held Bitcoin for 20 plus years, for example. Gold, yes. So I think it's like different cycles. And like, well, while we're talking about maturity, when do you think the crypto market will sort of diverge from its reliance on just Bitcoin? Because you're kind of talking about stocks and the market there. So do you think that we'll always have this reliance? Will there be some kind of breakaway?
I mean, if we're talking about Bitcoin's correlation to other markets, I don't believe that there is one. If we're talking about Bitcoin's correlation to the rest of the crypto market, then we obviously know that that's very strong. Like altcoins suffer tremendously when Bitcoin drops. Altcoins tend to suffer tremendously when Bitcoin rises fast as well. But if we're talking about other assets, I don't believe that Bitcoin is in any way correlated to the stock market, metals, or any other market. And if you look at it over its 12-year history, that's mathematically proven, right? The correlation is almost zero on the scale of -1 to +1. Of course, in a major risk-off environment, a black swan like COVID, everything crashes at once. But we saw that Bitcoin rose, like I said, from that point. I mean, it went up over 20 times, from the bottom to the top, much more than any other market. I mean, in fact, the reason a lot of people want exposure to Bitcoin, the Paul Tudor Jones and the Bill Millers and the Druckenmillers and all these billionaires, is because they believe that it offers idiosyncratic risk, meaning that it's not correlated to other assets, right? You can buy every stock, every bond, everything. When it all crashes, it goes together, right? You have systematic risk, which was proven over and over and over again through time. So even if you can put 5% of your portfolio in something that has even the chance to not react the same as everything else, that's like a unicorn for an investor in their portfolio. Even if you think that asset will perform poorly, the fact that it will not perform the same as everything else in the same situation is extremely valuable. So that's why you see these guys talking about put 1% in, put 5% in, put 10%. If everything crashes and Bitcoin goes up 100 times, you've covered your ass on your entire portfolio just by holding a small amount of this asset. And if it goes to zero, which it won't, but if you're thinking that it could, you lose almost nothing. You lose a few percent of your portfolio.
Definitely. And, everyone's been talking about, is Bitcoin an inflation hedge in the past month and different things like that. On the concept, on the topic of institutions, just looking forward in the next couple of years, or even what we've seen in the past years, do you think that like Bitcoin whales, or will it be institutions that sort of control more of the market going forward?
First of all, the inflation hedge thing makes me laugh every single time, as if you can judge the success of an inflation hedge over 3 months, right? It's the notion of it is so stupid. You're buying as a hedge against a consistent devaluing of the United States dollar for 50 or 100 years, not what's going to happen between June and July. So that whole notion is absurd. I just want to put that out there. As for institutions, I believe that a lot of the whales already are institutions, hedge funds and institutions that have been aggressively trading the asset. There's quite a bit of data that would show that. Those are not the OG whales that we all talk about who have had Bitcoin since 2010, 2011, 2012, and have these huge old wallets. But I do think that those institutions are already playing a role. The thing is, there's all kinds of different institutions, right? There are crypto hedge funds. They count as institutions, but that's not the same as a MicroStrategy or a Goldman Sachs or, these kind of household names. So I think that we are still in the infancy of institutional adoption in that regard, right? We've obviously MicroStrategy and Tesla and, Square starting to talk about putting Bitcoin in their treasury, taking a small bite. MicroStrategy much larger than a small bite, I think, per market cap. But we haven't really seen, beyond banks starting to open the doors to their clients to touch crypto, we haven't really seen that large of institutional adoption as far as they themselves gaining exposure to the asset. And I think that they're very interested. I think that just takes a lot of time to get past the risk managers and to be vetted. I think that we will see a time in the future when the huge wall of money, the endowments, the pensions, sovereign wealth, central banks themselves will have exposure to Bitcoin for the same reasons that we sort of discussed before. And to me, one of the keys to that would be the approval of a ETF in the United States, a Bitcoin ETF, right? Because then you would have an instrument that the risk managers would be easily able to push past without the security concerns, the custody concerns, the insurance concerns, without having to ever hold the underlying asset, right? Right now, they can do it with GBTC. We've seen a lot of institutions go through Grayscale, but it's a crappy product, right? I mean, right now it's trading at a 20% discount. It went up to 50, 60% premium, and you're paying 2%. So that's just it's a poor man's ETF. When we have a real ETF that trades within, 1% of net asset value and can be traded publicly by anyone, I think that will be really the key to that wall of money. And I think then, for better or for worse, those kind of institutions will become the true whales and will largely dictate price action. But to that end, it should become less volatile because a pension, which is good or bad, depending on your view, but a pension doesn't buy something to flip it in 6 months, right? They can't. So when that wall of money comes in, endowments and pensions, they're buying it to hold it for a very, very long time.
I think that's a good thing, especially seeing these large pools of money that people forget, that are kind of at the backbone of a lot of things. And I thought it was interesting that just recently Goldman Sachs, I think they announced like a DeFi ETF. It didn't even have many crypto companies in there, and it didn't even stand for like decentralized finance. But what do you think about things like that when you see Goldman Sachs or other companies kind of launching their own crypto versions that don't really hold the fundamental nature or the values of crypto? Like, like, is this going to be a problem for new retail investors? Like, they're going to be very confused.
I think they will be very confused. And I think I tweeted something recently about this. It was like breaking news, centralized mega bank, Goldman Sachs, offering decentralized finance product. Like, oh, the irony, and the irony of that should not be lost. But like you said, you remember in 2017, there was an iced tea company that was publicly traded that added blockchain to their name and the stock went up like hundreds of percent. I think that's what we're seeing here, right? DeFi is a catchphrase, and Goldman Sachs, being the dinosaur, but capitalist dinosaur who wants to capitalize on the trend, is doing this. And like you said, there's no DeFi in it. I read it, and it's pretty cryptic, but like it's a ETF that has companies like Microsoft in it, and they're pitching it as decentralized finance. It has nothing to do with it. And yes, I think it's intentionally made to take advantage of the term without exposing their clients in their mind probably to the risk. And it's just making an attractive name. It's a clickbait product for their customers. I do think it's dangerous and bad, but that said, it'll probably do pretty well. And in that regard, would be a net positive for the industry. I just think it's funny, the very notion of them doing something around decentralization. But the big banks are coming, right? We've seen, JP Morgan has now opened the doors to almost all of their wealth clients to be able to touch crypto. Of course, their CEO also said that he would fire anyone who traded it, and that it was a dangerous asset. But they watch what they do, not what they say, I guess. Bank of America is opening futures trading to crypto clients. They're all coming, right? And it's not because they want to. It's because they have customers who call and say, hey, man, do you guys have Bitcoin services? I want to get in on that. And if they don't want to lose their customers, they need to find a way to give the customers what they want, which is exposure to Bitcoin and crypto assets.
The demand is certainly there. And, these traditional companies, the way their business models are, they sort of adapt anything that, just makes them money. I'm not even sure what their real ethos are, right? Some of it is really messed up, giving out loans that they shouldn't. And that's what I really like about the crypto market. Even when you're taking a loan on chain, there's no other counterparty that's really judging you. You just have your counterparty risk. But while we're still talking about institutions, what effect do you think the custody nature of the funds like Grayscale or even these other companies custodying a lot of the Bitcoin, does that have any impact on the actual trading in the market? Do you think all of that money just sort of becomes illiquid? And like, how does that affect large movements in the market? Like, where do they come from?
Well, with time, it should increase the supply side shock that's already somewhat built into Bitcoin with the halving and obviously the mathematical scarcity and deflationary nature of the asset. We talk about it all the time. When you see a huge purchase, like billions of dollars on an exchange, and you see those coins moved into custody, well, that's $1 billion more of Bitcoin removed from the supply side. So assuming demand remains the same or increases, we should eventually see price go up if we see enough of that supply removed from the active trading market. I think custody is important, and there's a lot of hardcore Bitcoiners who would disagree, right? Not your keys, not your coins. If you're not custodying your own coins, they're not yours. But your average person, especially your average wealthy person who's used to other markets, is used to having a bank or a third party that they can trust with insurance to custody and hold their assets. There's a lot of people out there that don't want to be their own bank, right? They don't want to risk losing their keys. They don't want to risk a house fire and, the joke, losing their assets in a boating accident, right? Nobody wants to risk that. So I think for us to get the institutional demand and money, there have to be safe places for them to custody their assets. And we're seeing the PNY Mellons and State Streets, the biggest custodians in the world, are now talking about crypto and custodying assets, right? But if we're simply talking about as traders, it's always a good thing to see supply removed from the market. And like I said, the halving every 4 years, you basically have this, doubling in difficulty to mine Bitcoin, which effectively cuts the supply in half. So at the most basic level of supply and demand, if supply is cut in half and demand stays the same, price should double, right? And so with time, that tends to happen and more.
You're right. We have all these at least baked in mechanisms that gives a little bit of a predictability, at least for the amount of Bitcoins that are out there, the halving cycle. So I think all of that is really great stuff. But kind of going back to what we were talking about, just the maturity of the space and where we are right now. How much do you think like crypto sentiment, what a lot of these new players coming in, like someone like Elon Musk per se, it's not like he's been in he started the crypto market when it was a while back, like he's kind of a new entrant. But how much do you think crypto sentiment is still affecting the market, and is it always going to be this way?
No, it won't always be this way. It's only been 12 years, and so I think that it's important to keep that perspective. I also, as I said before, I think that the people that are moving the market with huge amounts of coins are likely using this news to sort of make frictionless trades and cause those cascading liquidations that we talk about, more than it is, oh my God, Elon Musk tweeted 1 million people are selling their Bitcoin. That's just not the case, right? Doesn't happen. And we're already seeing his impact reduce. I mean, he tweets about Doge now and the price doesn't even move. And that's a far smaller asset than Bitcoin. I think that there will be a time down the road when Bitcoin is viewed like every other asset. It's just a part of your portfolio, right? Even if it's small, you have some Bitcoin, you have some bonds, you have some stocks, you have some real estate, you have some gold, whatever it is, and it'll be considered a normal asset for people. I already think we're starting to see that happen. And at that point, the tweets of a erratic billionaire will be irrelevant. But Elon Musk can tweet about anything and the price will move. Right. So it's funny that we focus on Bitcoin and Doge, but you can't tell me that if Elon Musk didn't tweet about some random, 10 billion market cap stock, that it wouldn't have a tremendous effect on that stock. So it's more about him and his influence than it is about the crypto market in my mind. But yet again, I don't believe that it's the news that's moving the price. I think we had this parabolic run up. There was a ton of FOMO, and every time that happens in every market, the late entrants are punished, right? You buy the top, you could have bought at 10. I'm not going to buy at 10. It's never going to go up. It's too expensive. Goes to 20. Well, now it's really too expensive. Goes to 40. I can't buy it. It's $40,000 going to drop. Hit 60. I got to get in. This thing's going to 1 million, right? That's when it drops. And so you can see that in any market. And that's what happened here largely.
Yeah, I think that's a good point. You're right. Like if Elon Musk and some Michael Saylor, a lot of these people, I mean, they've built up influence over a large period of time, and we still have other like crypto influencers in the industry. So one thing I wanted to ask you is, have you seen anything from, I guess, your followers and their sentiment when these price crashes happen? Like what can you tell me about when the price crashes happen and we see a rebound? Do you think it's just the same people in our industry rebuying, or do you actually think new money comes in with something like stable coins? Do you track that at all? I'm just curious.
I don't think we're seeing a ton of new money come in right now. I think we saw that new money come in on the big rise, and some of those people sold and some of them are still holding. Again, if we're talking about very specifically as we're recording, we're a day after price sort of bounced from 30 to 40, in a very short period of time after dropping. Once again, that was leverage, right? There's no question that was a short squeeze. Funding for shorts, funding for perpetual swaps was negative. A ton of people were shorting. There was extremely negative sentiment, sort of the opposite of what we talked about at the top. And someone took advantage, just like you saw with GameStop on Robinhood or on the stock market, and price rose based on all those shorts. So I think that right now we're basically seeing money moved around. We're seeing the same people who know how to trade this market, trading it effectively. I think that it'll take some sort of catalyst to get retail really interested once again. Like I said, I mean, if you see a Bitcoin ETF approved or something like that, I think that there'll be quite a lot of interest, a positive news cycle, more retail and those things. But if you look at the on-chain data, almost all of the selling was done by wallets that have held Bitcoin for under a year, mostly under 6 or 3 months. So people came in heavily, they bought near the top, it dropped. They were either in profit and said, I'm locking in my profit, or they took a quick loss and said, I'm out of here, man, and they sold their assets. The large wallets that have existed for a long time have added to their positions, right? So smart big money has been buying in the 30,000s while retail sold back down. And that tends to be how it works, right? Yet again, it's Warren Buffett, right? The market is a mechanism for moving money from the impatient to the patient. And that's generally what you see every single time on a massive drop. You see, retail who didn't necessarily have a belief in the asset, who just bought because they wanted to get rich. They panic and they sell right into the hands of those bigger players that are eagerly waiting to buy that 55% discount.
Yeah, and I think one of the issues there is, like, for some reason, crypto is highly emotional. I would say, like, most investors and even traders, you're not going to do too well if you get attached to your assets. Although you have your Bitcoin holders, but from your perspective, because you're a trader in the space and you're giving a lot of great not investment advice, but a lot of knowledge and just education for how these different mechanisms work. With something like Ethereum and DeFi, like, how do you distinguish between things trading at the fundamental value or even like at the leveraged value, where you can do things like synthetic assets and it's not real money, it's leverage money? So how do you make that distinction while just looking at new assets to invest in?
I mean, DeFi is complicated for sure. And so I think that most people are better off concentrating on Ethereum or the larger DeFi platforms. And you have to be very experienced and knowledgeable, I think, to go further down the rabbit hole to these literally now thousands of platforms within DeFi. Because as you mentioned, it becomes very complex. I mean, obviously last year we saw sort of the rise and somewhat fall of yield farming, right? Where people would borrow from one pool and take those assets and borrow it somewhere else for a higher rate, and take those assets and borrow somewhere else, lending, right? And those houses of cards tend to fail. But out of that comes sort of the stronger platforms. And I believe certainly that there are plenty of people, I should say, who believe that DeFi will replace the global banking system. I think that it will run in parallel to it for those who are unbanked, underbanked, or want to opt out of legacy systems, and will offer another alternative. Just the very fact that you can get yield in DeFi and you can't in your bank account is a huge plus, right? Just the fact that you can earn any sort of interest on your assets. But I would say that what I tell people is stay away in general unless you've been in this market for years and years and years, and just focus on Ethereum, right? I mean, you can buy Bitcoin and view it as a store of value, digital gold, I think, inflation hedge, whichever narrative you choose for Bitcoin. That's one thing, right? And then you have Ethereum, which is really more akin to an investment in the internet in the late 80s or the early 90s. You're investing in a platform that allows people to exchange value, right? So you have the internet, which is the internet of information. I can send you an email privately, really without a third party, or information that's readily available on Google or anywhere on the web, from you to me for free, right? Well, what if you could do that with your money, right? And that's what DeFi is. It's eliminating the third parties, the toll collectors, the unnecessary middlemen in every one of our transactions. And that's important for people all around the world, especially when they don't even have access to a bank account, right? And so that's all being built on Ethereum right now. There are plenty of platforms that are interesting. I wouldn't call them competitive. I think they'll each find their own lane, and then they'll be interoperable using other platforms, right? And they'll just talk to one another. But you can buy Ethereum right now and effectively invest in that entire ecosystem without going down the rabbit hole. So for your average person, that's certainly what I would suggest.
That's really good advice, and especially about Ethereum. I think it's almost like it's just like the rails for decentralized finance right now. So that's a really good point. Just holding Ethereum. When we're talking about things like, I guess, inflation, how do you think the inflation in the traditional world of finance will affect crypto? Like, again, kind of talking about the inflation hedge, but I'm more so talking about, is our world of all our crypto products, is it safe from the inflation happening? Because people are also talking about and monitoring how many the stable coin input, and a lot of people think that that's going to give rise maybe even before Bitcoin. So do you kind of feel the same way?
Stable coins are dollars, right? So they're susceptible to inflation. They're pegged to a dollar. They should be backed by dollars. Therefore, they have the same inflation risk as a dollar. I have nothing against stable coins. I hold quite a bit of stable coins because, as I said, I can get 10% interest on those stable coins on a platform like Voyager that I use for trading. And, they offer me a 10% yield on my stable coins. So I'll hold them because that's obviously theoretically beating or at least competing with inflation. But the answer is nuanced, right? Bitcoin is an inflation hedge. Crypto is not an inflation hedge, right? And so you have to choose wisely and understand why you're buying an asset. If you buy one of these smaller coins that you're investing in a platform or the utility of that platform, that has nothing to do with hedging against inflation. In my mind, Bitcoin is the only asset that you buy as a long-term inflation hedge. And there are plenty other cryptos to buy for other reasons. It's just not that that's just not what the reason is, right? So I think that crypto is very susceptible to inflation, just not Bitcoin.
Definitely, because Bitcoin, you kind of have that. I guess it's deflationary. It's built into the protocol. I think one interesting thing I was thinking about while you were talking was, now that we have the rise of things like NFTs, and it looks like everybody wants to create a market for everything and make everything liquid. How do you see this affecting just general markets and even in trading markets in the future? If everything becomes liquid, like assets that were not liquid before and assets that you sort of couldn't split up. I think recently there was like a project 2 days ago, is like fractionalized NFTs. So do you think this is good for the market in the future?
That's like Inception, right? You go deeper down fractionalization to the point where you don't even know what you own at that point. I think it's good for the market, absolutely. I think that NFTs have just scratched the surface of their real use cases. It's kind of interesting. If you were looking at NFTs in 2017, 2018, I think art and collectibles was a very small part of what was exciting about that. And that's still the case. They've just been the use case that have seen mainstream awareness. But as you said, you can tokenize effectively anything and make it liquid. And those are also NFTs, tokenizing stocks, tokenizing your mortgage, tokenizing your car title, right? Literally anything, as I was talking about earlier, that can be transferred between two people that presently requires a third party. You can eliminate that third party and transfer it directly and know exactly who owns that asset through an NFT. That's a better world, right? In my mind, removing centralization from transactions and removing the fees associated and the predatory third parties that usually are in between. Try to send a bank loan, try to send a bank wire from the United States to Nigeria in the amount of $10, and you'll see what I'm talking about. You can do that easily with a stable coin. That's part of decentralization, right? So we're looking at any system that allows us to remove the third party. And for all of these other assets, NFTs will be that system. Once again, mostly built on Ethereum, right? So buying Ethereum is also investing in the potential of all of these things. And so I think that, it would remove a lot of the problems that we have with transacting directly. Even going back to GameStop and Robinhood and what we saw there, Robinhood had to freeze trading on GameStop. Now they could have also turned off the sell button and not just the buy button, but they had to because they couldn't cover the costs of filling orders when it was a 48-hour time to clear those orders through a third party. Now imagine if all of those stocks were tokenized and it was instantaneous, they wouldn't have had any of those problems, right? So I believe that tokenizing everything is absolutely the future, and eliminating third parties and allowing for it to be decentralized is just a necessary step in the evolution of transacting.
Definitely. Everyone's talking about building new bridges. Interoperability, of course, is a huge theme still. I think everyone's starting to figure out that, in order to get the mass market, you need to get out of your corner of the space and even bridge to even some of your competitor tokens. How do you think people can most benefit with using crypto in their daily lives right now? Like anything further than just buying and selling?
Depends on where you live. It's really hard in the United States. And that's just a fact because it's not viewed as money, it's viewed as property. So buying coffee with your Bitcoin, as attractive as that may sound to some people, is a taxable sale of your Bitcoin. If I want to send you Bitcoin, I have to pay the taxes on selling it effectively to send it to you, right? And so I think that the laws right now, the tax law certainly is very prohibitive for us here, but there are places in the world where they don't have those laws. And I think if you live in Venezuela and you have hyperinflation and your currency is worth nothing, you can probably live for a month on $100 worth of Bitcoin, right? So I think it's location to location and use case to use case. I think there are plenty of places in the world where using Bitcoin on a daily basis is valuable. And there are probably more places in the world where right now it's best to buy it and hold it and wait and see what happens.
That's actually a good point. Yeah, it depends on where you are in the world. In some parts of the world, that's pretty much the only currency that you have to use now, right? It's becoming legal tender in many areas. And I think that's really great to see the different utilities around the world for sure. And looking forward, what's the most exciting use case that you're currently excited about in the next year? Like, do you think it will still be around like crypto products, or do you think there'll be kind of like a blended product from one of these companies? Like, any guesses on which company will announce a more crypto native product next, like similarly to Square?
I'm really not sure, and I hate to conjecture, but for me, it's not what's happening in the legacy systems that excites me. It really goes back to DeFi, I think, and I'm not talking about that as an investor or a trader. I just think that when you drill into what crypto was created for, the real importance of it, the real use case, it's to have decentralized money, to not be controlled by your government, and have the ability to transact freely with whoever you want, whenever you want. And I think as we see the market mature and as we see these platforms develop, I think that we will truly see this become a competitor, not a replacement, but a competitor for those global systems, and I mean, and if you want to talk about the institutional side, I mean, the OCC has said banks can test stable coins now instead of SWIFT transactions and, ACH. They can custody these assets. So I do think that we will see a blending of, legacy systems, utilizing them just because they're superior and faster, and the people, retail, using it completely outside of that system and not having to touch those predatory systems. So for me, what I'm most excited about in crypto is not about the number going up or, how much profit we can make trading it. It really is about the, paradigm shift to better systems that help people all over the world.
Definitely. And it's also hard, although these are great core principles, it's really hard for new people, I think, coming in to, not everyone is interested in those things to get exposure for crypto in the sense of, not everybody outside of the market shares those same principles. So to sort of wrap things up, what are 2 to 3 of your ethos or principles that you kind of tell new people getting into the market? Just general advice.
That's a tough one. That's a tough one. I would say, first of all, if you're interested in this space or any space, do your research, right? It's just like, it's exactly what you just said. Most people are buying it because they're speculating and somebody has told them to buy it and that it might go up. And they don't understand all of the use cases or the importance of the asset as I've sort of described, right? They don't understand it's an inflation hedge. Maybe they don't understand inflation at all, right? Most people, I think, are not even aware of what money is or where money comes from or why it's such a risk to have your government printing money endlessly. What does that mean, right? They don't teach us financial education in the United States. Most countries, I would imagine, is the same. Maybe you learn how to balance your checkbook in school or something like that, but nobody teaches you about credit and loans and debt and money. Don't even know what it is, right? You just take it for granted. It's the stuff that you exchange for goods. And so I think if you go down the rabbit hole, which I tell people to, and have a better understanding of money, read the book Sapiens, for example. If you want a quick start, I always tell people just read Sapiens. It'll give you a much better understanding of why Bitcoin is important first, right? And then I tell people just start dollar cost averaging really small. Get a little bit of it, touch it, move it around, learn how to send it, learn how to receive it, learn how to buy it, learn how to custody it. And then after that, maybe consider Ethereum. You know, once you've got some Bitcoin, take a look at Ethereum, do the same process, go through the research, understand why it's important, understand what it is. And then you're a year or two deep and you start looking at all the other assets, right? And it's funny, I used to think that Bitcoin was sort of the gateway drug to all of these other coins and assets. But I had all these people in my life who are, you know, in their 40s like me, who I always said, buy Bitcoin, buy Bitcoin. And I gave them these lectures and they didn't care. Like you said, they don't understand, or they just never have thought that deeply about money. Then I say, go buy some USDC and park it and get 10% interest, just like you did in the 1980s on your savings account. And they go, really? And they do that, right? So now I think actually like CeFi, the Voyagers, BlockFi, Celsius, Nexo, Amber, Abras of the world, right? I think those are the gateway now into crypto, because your average person says, I can get 9 or 10% on dollars with no volatility, and they're willing to do that. And then they start thinking about Bitcoin and other assets. So I tell people to check that out as well. You know, understand the counterparty risk, understand how they're gaining that yield, but, you know, maybe consider just doing anything in the crypto space to sort of hedge against what's happening with your money.
That's a great way to end things off. You kind of described the ultimate flywheel. Like that's the best way to de-risk yourself in that sense. Yeah, Scott, thank you so much for being here today. And lastly, you know, I want to give you a chance to shout out your newsletter. How can people connect with you and like just follow your thoughts?
Sure. Twitter is the best place, at Scott Melker, SCOTTMELKER. And from there, you can kind of find everything else, go down the rabbit hole. I have a podcast, the Wolf of Wall Street's podcast, that comes out twice a week, something I'm very passionate about. It's the best job in the world. Get to call anyone you want and ask them questions for an hour. Who would have never given you the time of day otherwise. It really is the greatest thing. It's like, I get paid to do this. It's incredible. And then, as you mentioned, I have a newsletter that comes out 5 days a week, and a YouTube channel where I have multiple pieces of content coming out every day. I mean, my goal really is mainstream adoption of cryptocurrency, you know. And so I work every day pretty tirelessly to try to make that happen, putting out educational content and trying to make it accessible to brand new people. You know, I think the people that are here already get it, right? So it's kind of banging your head against the wall to focus exclusively on them. I really want the average person who can benefit from this to understand the importance and to jump on board.
Definitely. You make great points. Really love your ethos. And I might be a little biased because I'm a fan of you myself, but no, definitely check out Scott's work. He's, I don't even know when you get the time to sleep, but the market doesn't sleep. I don't think you
sleeps.
do too, but
we don't sleep. I've slept more actually since price has gone from 65 to 30 than I ever did on the way up. So
we'll just hold and figure it out along the way. But Scott, thank you so much for returning to Reimagine. It's always a pleasure speaking with you. Market is different. Our conversations and thoughts are different, but as always, we're very excited for the future.
Thank you so much.
And for the rest of you still watching, we're bringing you more interviews here at Reimagine 2021 version 10. Check out our full YouTube library. We've done over 500 interviews now. And as usual, we always return every single month, you know, bringing you the latest founders and new news in the space. Thank you, everyone.